Ladies and gentlemen, good afternoon. My name is Samir Shah, and I'm an M&A partner in Khaitan & Company's corporate M&A group. Welcome back to yet another webinar. This will, however, be our last webinar in the second edition of our M&A Academy program. As you know, this series was started to provide foundational legal knowledge and understanding on M&A transactions and processes to corporate executives, in-house legal teams, and other M&A ecosystem participants. Our subject today is hostile takeovers in India. Last year, we looked at public M&A in India as a part of the M&A Academy. We received incredible feedback, but there was also a section of feedback suggesting that we should try and do something more focused and more niche in this space. We felt we could perhaps present an analysis of real live examples of hostile takeovers of public companies in India and an overview of the regulatory framework. If you are a promoter, you would have some control on a competitor acquiring your company if it was a private company or a closely held public company. The danger, however, in a publicly listed company is that even though you may not be a willing seller, someone else interested in your business may still be able to conclude a buy transaction. This is precisely what is called a hostile takeover. As with any other publicly listed company acquisition, this tends to be a little tricky and requires experienced and knowledgeable advisors. Today, we will try and give you an overview of this entire process. The format is very much the same. We will have a formal presentation followed by Q&A. So please feel free to continue to submit your questions using the Q&A chat box. We will, of course, respond offline over email if there are questions that we cannot address. In any event, the presentation, the summary notes, and the recording will be shared with all participants, and the recordings, as always, will also be uploaded on YouTube. If I can introduce our speaker today, we have with us my partner Abhishek Dadu, who is an M&A partner based in our Mumbai office, although he works on projects nationally. Public M&A is his calling, and he has more than a decade of experience of doing just that. We circulated his profile over email to everyone who registered for this webinar, and as you may have seen, ladies and gentlemen, he has advised on many high-stake transactions. So without further ado, I now invite Abhishek to deliver his presentation. Over to you, Abhishek.
Thank you, Samir, and thank you to everyone who's taken the time to join us. Today we discuss hostile takeovers. Our presentation is going to be split into two parts. The first part is to provide an overview of hostile takeovers in India, the regulatory regime around it, and the key defenses that come into play in case of a hostile takeover. The second part will comprise of three very interesting case studies that we've picked up of hostile takeovers which have been successful in the last few decades in India. And of course, at the end, we go to a Q&A session where we'd be very happy to answer any questions that you may have. A hostile takeover in its simplest form refers to the acquisition of control of a listed company where the management of the company is opposed to such acquisition. Now, a hostile takeover is perhaps the most interesting and also the most complex part of public M&A. It has various factors which come into play, not just legal, but commercial. And in the course of our discussion today, we will try and run you through the various aspects that become relevant in a hostile takeover. But before we get into the concept of a hostile takeover and dive deeper into the concept, let's start with the preliminary question. Is a hostile takeover necessarily bad? Now, the answer to that question is, of course, subjective. What is good for the acquirer in a hostile bid is necessarily bad for the existing controlling shareholder who does not want to give up his stake. But what we have seen across hostile takeovers is that it results in excellent value return for the stakeholders, especially for the public shareholders, which gives us some food for thought to consider whether overall a hostile takeover is something which is good or bad, but ultimately it results in benefiting the larger public shareholders as a whole. So let us begin with understanding the hostile takeover regime in India. As we discussed, a hostile takeover is the acquisition of control in a listed company where the management of the listed company is opposed to such acquisition. Now, this acquisition can take place by an existing shareholder holding a minority stake, or it could occur by an absolutely unconnected third party who believes that they can come in and acquire control of this listed company. It's very important to keep in mind that a hostile takeover is relevant only in the context of a publicly listed company. It is not something which is relevant in a private company because those shares are privately held. They're not available on the market for anyone to buy, sell, or trade. Therefore, all the concepts relating to hostile takeovers are essentially dealt with in the listed company regime. Now let's take a simple example to try and understand how a hostile takeover may be implemented. Now let's assume that Tesla, which is a car manufacturing company, is to come to India. Its shares are listed on an Indian stock exchange. Its promoter, who is Elon Musk, owns 30% stake in Tesla, and the rest of the 70% is with the public. And now Samir thinks that he wants to buy control of Tesla because he believes that he can run the company equally well, if not better. In that case, the question is Samir enabled to try and launch a hostile takeover? And the answer is yes. All Samir needs to do is find a 25% block or higher in the market who are willing to sell their shares to Samir. And with that, Samir buys the 25%, triggers a mandatory tender offer, which is for an additional 26%. And Samir has a runway to a 51% shareholding in the target company, potentially getting a higher stake than the existing promoter. Now, of course, this is a very simplistic understanding. There are a lot of nuances behind this, but the idea is just to tell you that there is a pathway in case of most listed companies to try and launch a hostile bid. We will come to why hostile takeovers in India are less common, but that's the broad theory around hostile takeovers. From the what of hostile takeovers, let's come to the why. The simplest answer to why a hostile takeover is launched is value. When an acquirer sees value in any asset, they try to acquire it. Let's try and use a non-law example. Let's say you go into an antique shop in a small town and you see this old dusty painting. On closer inspection, you realize that the painting is actually a raza, which is clearly very valuable. Now, stocks work in a very similar manner. You have found something in case of a painting which is very valuable, but it's not currently being sold at that value, at a much lower value. In case of stocks as well, you find a company which you believe should be at a much higher value because you believe there are certain incorrect synergies, the management is not running the company properly, and things could change if you were in control. So that is the why of a takeover. Usually it's a value creation method where you try to take over the company, improve its management, its synergies, perhaps even retrack its business model to make it a more valuable enterprise overall. Now, the takeover regime in India is governed by the Takeover Code. Interestingly, the Takeover Code does not have any reference to hostile takeover. So neither does it provide specifically for a hostile takeover, and nor does it prohibit or bar a hostile takeover. So in effect, the way the jurisprudence or the regulatory regime around hostile takeovers has evolved in India is to say that you are free to do a hostile takeover as long as you stay within the four corners of Indian regulations. There is also an aspect of the role of the board. In India, the role of the board in case of a hostile takeover is primarily limited to their fiduciary duties. Globally, there are certain concepts like the Revlon rule, which talks about the fiduciary duty of the board to act to protect the company till a certain point in time. But if a hostile takeover is imminent, then the fiduciary duty of the board is flipped to try and find the best value for all the stakeholders rather than continue to defend the hostile takeover. Now, just to be clear, this is not the legal position in India, but an influence, of course, can be drawn from other jurisdictions. In India, what we see is the number of hostile takeovers is quite limited. If you compare it to the number of M&A deals that we see, or if you compare it with other jurisdictions like the US or the UK, we see far fewer hostile takeovers. Now, why is this? The primary reason for this is that most listed companies in India have a highly concentrated shareholding, which is to say that the promoter family of the listed company would own anywhere in the range of a 60 to a 75% in the listed company, and of course the remaining being part of the public float. Now, when a promoter or a controlling shareholder owns more than 50%, in this case, say anywhere between a 60 and a 75, any attempts of a hostile takeover may be futile. Because in effect, what you do in a hostile takeover is you try to buy from the public. And if there isn't enough public float for you to buy to get to majority, then the entire effort of launching a hostile takeover may be lost. Another important aspect is the role of the board. While the shareholders do take certain important decisions by way of their shareholder vote, the day-to-day operation and management lies with the board of directors. So hostile takeover doesn't become successful just by buying up these shares which are available in the market. It is after that you buy the shares that you also need to then engage in reshuffling the board, where you get your nominees, your representative on the board of directors, and potentially remove the nominees of the earlier promoter. Now, of course, you would have the votes if you have majority shares, but a reshuffle of the board can often be a long and expensive process if the matter goes into litigation, which we have often seen happen in the past. The third and final important aspect while considering hostile takeovers is the market reaction or the perception. Now, we did go into this in the beginning with our question on whether a hostile takeover is good or bad. Now, there is no clear answer to this. There is, of course, a perception that a lot of investors, and we see many investors think about that when they are considering a hostile takeover, is whether we will be perceived to be a hostile investor in nature, and does that impact our ability to do other deals. But as we will see in some of our examples, hostile takeovers have not only resulted in much higher value creation for the public shareholders, but also for the existing promoters who managed to enter into a settlement and get an exit at a substantial return. So once a hostile takeover is launched, the next part that becomes relevant is the defenses which are available in case of a hostile takeover. Now, these defenses are in the nature to protect the company if a hostile acquirer is seeking to buy shares. What we will do is touch upon a few of these concepts, and when we get to the case studies, we will also discuss how some of these were attempted to be implemented. These are all successful hostile takeovers. So while these defenses were attempted, they were not successful. The first defense that we're going to speak of is the poison pill. The poison pill is essentially a mechanism where the company, the listed company itself, issues shares to the current promoters at a substantial discount. So, for example, let's use the Samir and the Tesla example. In that case, if the company Tesla was to try and defend itself, it could issue shares at a very low price to Elon Musk. Now, what that would do is it would increase Elon Musk's overall stake in the company, also increase the overall capital base, and thus making the entire hostile takeover process less attractive for Samir to try and pursue. Another one is Pac-Man. Pac-Man, I don't know how many of you would remember the game from back in the day, but effectively what the Pac-Man defense entails is if a company tries to buy another company, so the hostile acquirer tries to buy a listed company, the listed company in turn starts buying shares of the acquirer itself to make it very clear that, look, before you end up acquiring me, there is a possibility that I might end up acquiring you. This obviously makes the parties rethink their strategy on whether they would like to pursue a hostile acquisition. Here again, the obvious point being that both acquirer and the company need to be listed. Going back to our first point, that you would need a listed company for the purpose of a hostile takeover. The third is a crown jewel defense. Now, a crown jewel is really the most valuable asset in the company. So if you were to take a car manufacturing company, it's probably your manufacturing unit. Now, if you would look to thwart a hostile takeover, one approach that could be adopted is you try and sell the entire unit in itself to a friendly third party, to another group entity. And what that would do is effectively leave this company that is subject to the hostile takeover as a shell. And then there is no point in the acquirer continuing that acquisition. There is also the white knight defense, which we will discuss in one of our case studies, which effectively means that instead of the hostile acquirer buying shares, the company goes and finds a friendly third party who would acquire these shares and hold them for a certain period to ward off the hostilities that are being faced at that time. So these are broadly the concepts that we see around hostile takeovers, the what of hostile takeovers, the why, the regulations, which effectively give you a free hand to try and acquire shares, because the process really is quite democratic. It's always based on the will of the public shareholders on whether they want to sell their shares or not, and who has the better strategy, who has the better price, who has the better defense if you were trying to prevent a hostile takeover from taking place. With this, we now move to the case studies. The first case study that we have is of L&T's acquisition of Mindtree. Now, I'd request all of you to look at the diagram on the right. That would be the starting position of the company. And I'll walk you through the facts and the background and how this deal was broadly constructed. So if you see, Mindtree had a promoter stake of around 13% and a public stake of 87%. And of this 87%, 20% was held by one particular group, which was owned by a gentleman named Mr. V.G. Siddhartha. Now, let's go back to one of the concepts we discussed earlier. Why are hostile takeovers less common in India? Because shares are concentrated in the hands of a few. Now, in this case, you see that the promoters actually have a very low shareholding. They are nowhere in the 50s, 60s, 70s range. In fact, they're at 13%, which makes this company ripe for a hostile takeover. Now, why they reached 13%, it's because of years of further investment, sell down, etc. But what matters is that they were, at the time of this hostile acquisition, at a low holding, and therefore open to a hostile bid, which is exactly what happened. In this case, L&T entered into an agreement with Siddhartha to buy his 20% stake. Now, there was a lot of background on why the 20% stake was sold. We're not going to go into that. The idea is just to understand this from a hostile takeover perspective. So when this discussion was underway between L&T and Siddhartha, the existing promoters of Mindtree and Mindtree itself was opposed to the idea of L&T coming in as a new controlling shareholder. And the simple reason being that if L&T came in, they would become the largest shareholder, the controlling promoter, and in time, they had also made their intention clear that they would like to merge this with their own IT business division because they saw a lot of synergies that come into play. So ultimately, you did have the management oppose the acquisition. They even tried a few poison pill methods, which we will come to in the next slide. But ultimately, what we see, and that is the second diagram that you see on your right in the table, they were successful in their hostile takeover, reaching a total holding of 60% from zero in the company and becoming its new shareholder. So how did they achieve this? What was the deal structure that they adopted? L&T sought to acquire shares of Mindtree through a three-prong approach. The first approach we've already discussed, which was the 20% stake through a negotiated share purchase agreement. The second, they placed a market order to buy 15% from the market. And again, here they have the flexibility. It's a market order for 15%. So they can buy 0, they can buy 10, they can buy 15. In this case, they ultimately ended up buying a 9% stake from the market. And a combination of the 20% share purchase and the market order for 15%, since the two breached the 25% threshold, resulted in triggering a mandatory tender offer. A mandatory tender offer under Indian laws is to be for a minimum size of 26%, but in this case, they launched it for 31%. Now, that's not a coincidence. If you see the numbers, they are very telling. The SPA is for 20%, and the mandatory tender offer is for 31%. If you add them up, they come to 51%. What L&T is trying to do here is keep a runway for itself to hit that magic 51% number. Now, in an open offer, of course, the tendering is subjective, right? Shareholders may not tender in the open offer. And that's where the backup comes in the form of a market purchase of an additional 15%, where they have flexibility to buy more from the market if they want to further increase and hit that magic number of 51%. Ultimately, what we see is all three guns fired. They managed to buy the 20% in the SPA. Of the 15%, they bought 9% on the market, and they got a full 31% tendering in the open offer. The promoters of Mindtree, of course, tried certain defenses. One of them was exploring a buyback, where shortly before the deal was announced, they tried to bring about a buyback. Now, why would a buyback be a poison pill or a defense? Effectively, what you try to do is reduce the public float that is available. So you buy back shares, reducing the total number of shares, making them more expensive in the process, and also reducing the public shareholding and increasing proportionately the promoter shareholding. But because of the resources available with the company at the time, a buyback was not practical, and therefore they had to abandon the plan. The promoters also tried a white knight defense, which is effectively to try and find friends or helpful third parties who could buy their shares. But as it turned out, that was not something that was feasible either. Now, the third slide here is a very interesting one. This is telling of the price movement. What we've done is we've tracked the market price through the entire journey of the hostile takeover. If you see the volume weighted average price, which is the price prior to the takeover, was somewhere in the range of 880. Now that's again on slightly on the higher side because some news had leaked about the takeover. So let's say it's somewhere in the 800 to 850, 860 range. The open offer that was launched was at a price of 980, which is a substantial premium to the market price at that time. Now, this is important because you have to be mindful. In a hostile takeover, the idea is to incentivize the public to sell to you. That is the only reason they're going to sell their shares, because they get an immediate higher return. So through the course of the open offer, you see that the price sort of goes closer to the 980 number. And as the open offer is ending, the price had corrected further. It was in the lower 900s, which also explains why you had such high tendering, because people immediately got a better value and institutions decided to tender their shares at 980 rupees rather than sell on the market at a slightly lower cost. The next case study that we have, and I'll keep sort of comparing these case studies as we progress. The next case study we have is of Tide Water Oil getting acquired. Now, again, if you see the pre-takeover holding, in that Tide Water Oil, a listed company, had a 26% promoter stake. Compare it to L&T, where they had a 13% promoter stake. Standard Greases, which is the public shareholder who launched the hostile takeover, they had a 24.9% stake. And compare it now to L&T, where to Mindtree, where L&T had a 0% stake, right? Going back to our initial discussion, a hostile takeover can be launched by somebody who has a minority stake as well as somebody who has absolutely no stake or interest in the company at all. So in this case, what is very unique was that Standard Greases did not have any underlying transaction when it launched the open offer. It did not enter into a contract with an existing shareholder as had happened in Mindtree. They merely announced their intention to acquire shares and control of the listed company. Now, this is a very, very interesting structure, because effectively what they said was that, look, we are at 24.9%, we want to take control of this company, and we are inviting the public to come and sell shares. This is the price you're offering. If you think it's a fair price, come sell to me. I'm going to cross the 25% threshold, giving me certain rights, and I want to be classified as a co-promoter of this company. As it turned out, of course, the existing promoters opposed the hostile takeover. This was also a Government of India owned company, so that had its own complications on how to navigate the process. But finally, they achieved a 4.4% tendering, and they also bought some stock on the market, and they hit a 30% stake, making it a successful takeover. And they became co-promoters in this company along with the existing stakeholders. Now, there were certain attempts made in this hostile takeover as well to try and thwart the entire acquisition. I'm going to explain that more in my next slide, where the pricing is there. But effectively, the board made certain announcements of a stock split and a bonus, which caused the price to rise and therefore make the entire acquisition less attractive for the public. But ultimately, what we see here is that in a case where there was no underlying transaction, it was purely a democratic process where the acquirer went to the public, said, sell me your shares, this is the price I can offer. They were able to successfully acquire control of a listed company. Now, let's go to the pricing, and this is very interesting. If you see the price, and the stock price in this one was around 16,600, because the stock was very thinly traded. So it had a small capital base, therefore the per share price was actually much higher. So the normal price around the time of the open offer was around the 16,600 phase. The initial open offer was launched at the bare minimum price they could. But as the open offer progressed, the acquirer increased the offer price by almost 1,000 rupees. Now, in a stock which is illiquid, there are not many buyers, not many sellers. If you have somebody who's offering a 1,000 rupee premium per share, and with a big 26% order which is available, that's a very attractive proposition for a lot of sellers. And that is exactly what we saw. We saw 4.4% tendering. And you see that spike here in the middle, which happened sometime in December. The stock price actually went from around 16,600 to 31,200. That's almost a doubling of the stock price. And this was on account of certain decisions taken by the board to try and announce a stock split, a bonus, which was not carried out immediately. But by the time these corporate actions were announced, a certain amount of tendering had already taken place, and Standard Greases had acquired control. Now, this matter was again very interesting, because I recall when this matter was ongoing, there was a change in law that had happened. And this is the first time that a regulation was introduced that a public shareholder, if it wants to be classified as a promoter, it has to go through the open offer route. So it actually was an enabling provision where a public shareholder used that entry to say that, look, SEBI, effectively you said that if I want to become a controlling shareholder, I must go through the open offer route. So from an indirect mechanism, I have followed the process, and now I plead you to allow me to become a co-promoter, which is effectively what we managed to achieve in the transaction. The third case study is of Imami Zandu. Now, this is a slightly older one, but I picked this because it's also a very interesting one, and it shows how not only the public shareholders benefited, but also the promoters who were sort of staying back also benefited in this transaction. So again, the background here was the promoters held 42%. Let's compare that. You'll notice there is a trend here that the shareholding keeps increasing with each case study that we've done. We started with Mindtree at 13%, Tidewater at 26%, and here we are at Zandu at 42%. Now, the catch in Zandu, of course, was that there were two promoter groups. One was the Vaidya family, and the second was the Parekh family. The Vaidya were the passive investors, whereas the Parekh family, they were the ones in day-to-day operation and control. And it was the Vaidya family who decided to sell 24% of their stake to Imami. So effectively, Imami, which in this case had already acquired 4% on the market, entered into a contract to buy an additional 24% from the Vaidya family, and in the process, they triggered a mandatory tender offer. Now, this was under the old regulation, so the size of the open offer was smaller. Instead of 26% back then, it was 20%. We see here that Imami was ultimately successful in buying the 24% from the Vaidya family, who were co-promoters. They were also successful in getting the full 20% tendering in the open offer. And as a cherry on the cake, they were able to reach a settlement with the Parekh family, which was the current promoters, which was opposing the entire hostile takeover. They managed to reach a settlement with them and actually buy out all of their shares as well. Now, this gives you a clear indication that you can have all buyers, even in all winners in a hostile takeover. Typically, you wouldn't want to stay back in a company where part of the shares have been acquired in a hostile manner, because if you have hostility in a listed company, the only thing you will do is destroy value over time. And usually both parties are smart enough to realize that there is more merit in at least one of them exiting and letting the other continue with the operations than both continuing to fight over time and deplete value. So in effect, what happened was that Imami was able to acquire a 70% stake in the company. And of course, this process was quite long drawn. It was fought before SEBI. There were complaints. It went to the Bombay High Court, the CLB. The Parekh family, in fact, tried to use a few poison pill methods. One of them was they tried to do a preferential issue of 5%. Thus increasing their stake and diluting the public. They also tried to appoint 5 directors on the board of the company, thus cement their position as majority shareholders, filing complaints before the regulators. But ultimately, none of these defenses were able to stick, and Imami was able to successfully complete its acquisition. So in summary, on these 3 case studies, what we've tried to convey is that there is, of course, difficulty in the process of completing a hostile takeover. We have kept it very simple, but ultimately the hostile takeover process is actually a very well thought out, very well orchestrated process. In fact, if you look at the last slide on Zandu, it gives you a sense on the pricing. So let me explain how the sort of pricing metric worked. The original share purchase agreement from Vaidyas was at 6,900 rupees. Right? This is initial stages. They've bought the 24%. They've triggered an open offer, but you had Parekhs who were continuing to fight the Imami group for control. Now, ultimately, to incentivize the public and to incentivize the Parekhs also in some ways, Imami increased the price from 6,900 to 16,500. That's more than a double increase. But for Imami, that made sense because economically, they saw it as a better investment to get full control of this company, maybe paying a slight premium, than continue to fight with a co-promoter who they don't get along with. So, as I was saying earlier, ultimately it's a function of the deal logistics, the price that is offered to the public, the co-promoters, and how you structure the transaction. Whether you manage to ensure that you have secured your minimum stake, which would allow you to complete your majority acquisition. Do you have a sort of plan B, a backup, like we saw in the L&T case? Are you able to enhance your line of credit, like we are seeing in the Zandu case? And are you able to be innovative in your structuring, like we saw in the Standard Greases case, where there was no underlying transaction, there were no immediate sellers they were able to identify, but they were still able to find a way to get the public to tender their shares in an absolutely transparent and open process. I think with that, we come to an end of our case studies and our presentations. I hope you've enjoyed the session. We have tried to summarize and convey the overall regime of a hostile takeover, the key defenses that come into play, and how these have been implemented through certain case studies that have been successful in an Indian context. With that, Samir, back to you.
Excellent. Thank you very much, Abhishek. And I can see the chat box that has been buzzing. There are, of course, a few questions in private company transactions. So I think there are enough people who reacted to my comment that in a private company you're a little better covered if you're a promoter and an unwilling sort of seller. But be that as it may, I think we'll confine today only to all of the public company Q&A. So maybe why don't we pick up with Imami Zandu? And you mentioned, I saw on the slide that you spoke about them trying to do a preferential issue. There are a few questions on maybe trying to understand a little more on whether the preferential issue, is it really effective as a poison pill, or what are the challenges in implementing it as a defense?
Yeah. So thanks, Samir. That's a very good question, whoever's asked it. So let's first analyze a poison pill from a global context, and then let's bring it to India. Globally, poison pill is a very effective defense. So if you think of Netflix, Netflix has an ingrained poison pill mechanism where they were able to ward off hostile takeover attempts, where if any shareholders goes above a certain threshold, there are automatically much cheaper shares issued to the other shareholders, in the process making a hostile bid very unattractive. In an Indian context, however, there is a certain amount of nuance. And the reason for this is that the Indian pref issue is not a free pricing issue. A preferential issue by a listed company must happen at a minimum prescribed price. So what that results in is that you cannot just do a pref issue at any price which is at a substantial discount. So if at all a pref issue is to be used as a poison pill, and in this case, effectively to enhance the shareholding of the promoter, it will come at a cost. And that cost is linked to the market price of the listed company.
And therefore, it effectively is a difficult defense. Fair enough. That makes
Therefore,
sense.
so correct. So it is a defense, but it comes at a sort of substantial cost, which in a way sort of mitigates it. The whole idea of a poison pill being that it's an easy way to deflect, whereas here really you would have the promoter to go out, get a line of credit, take that risk of really infusing all that money into the company, and over time, of course, repay that money. So it's a personal risk that you take on.
Understood. So maybe if we switch to another case study, you spoke about L&T Mindtree. I think that's obviously a transaction really, really spoken about. There's a question on, and again, I don't know to what extent you can talk about it, but what sort of defenses do you think, if you were on the L&T board, would you be considering, or how would you sort of react to something of this sort?
Yeah. So I think some of these case studies, given we were involved in these matters, I sort of limit it to theoretical analysis rather than how the board, what sort of other approaches were there. In fact, in L&T, and let me try going back to that slide, they did consider a couple of viable defenses. One of them was a buyback. Now, in the buyback, what would have happened is that L&T, the promoters of L&T, they wouldn't have participated in the buyback, but the public would have. And in the process, the promoters' shareholding would go up, the public shareholding would reduce, and thereby making the process unattractive. But what ultimately, and this is again in the public domain, so I'm free to speak of it, but ultimately what happened was that to do a buyback, you need resources, right? You need money. It needs to come from a certain kitty of the company's capital. And the resources that were available at that time with Mindtree would have resulted only in about a 4% buyback, which really wouldn't have moved the needle much. So it's a bit unfortunate because under other circumstances, that might have been a more viable option. There is also, of course, the other element of governance concerns, whether launching a sort of poison pill would result in independent directors raising concerns, etc. But in an Indian context, we've seen independent directors really comply with their fiduciary responsibilities and duties and do what is best for the company and the public shareholders.
Perfect. I think, and in fact, there's a very interesting question separately by somebody who I can see on can a buyback be possible by a loss-making Indian company with negative results? I think you obviously addressed that question in some shape or form. Let's maybe jump. So we were on directors and fiduciary duties. There is this Revlon rule we talk about. So what is that? What is the applicability to what we're discussing? I'm just trying to bundle a few questions together.
Yeah. So Revlon is a very, very interesting legal principle. It's born out of the Delaware Supreme Court in a hostile takeover situation that happened in the US. And effectively, the principle states that the board of a company's primary obligation is to defend the company against a hostile takeover. That has always been the fiduciary position. But in this case, the court brought in an additional layer to say that yes, while the board is correct to try and defend the company from a hostile bid, after a point when this hostile bid becomes imminent, you know that the hostile bid will be completed, will be successful, the fiduciary duty of the board pivots. It suddenly changes from trying to fight the hostile takeover to finding the best value for the public shareholders and in a way accept or facilitate the hostile takeover. Because what we need to understand is the duty of the board is not to a particular limited set of shareholders. The duty of the board is to all its stakeholders. So if you know that a hostile takeover will go through, then what you do is you work towards finding the best value for all your stakeholders, like we saw in the Zandu example, right? Over there, the price was 6,000, and finally you had a situation where parties were able to find a solution where they got a 16,000 plus return on each share, and not just the public shareholders, but even the outgoing promoters getting a massive return on their holding.
Understood. So since you're on price rise, there's actually a question. It's not a legal one, but you live and breathe this space. So if there's a hostile takeover, why does it make the price jump? What's the market reasoning for it?
Right. So a hostile take. So a lot of this goes back to basic economics. You have supply demand. You also have a sort of a value perception. A hostile takeover, like we discussed right in the beginning, right? The old dusty painting example. The reason a hostile takeover has been launched is because somebody, rightly wrongly, believes that a company is more valuable than is currently being traded at. Now, in that case, you will have a lot of people who buy into the same thought or rationale, and they invest. So you have two buckets. One is people who believe that, okay, look, we do see a potential, so let's invest, stay invested. There's a second bucket of arbitrage holders who say that, look, this guy thinks there's more value. He's launched a hostile takeover. Let me buy more and more shares, and I'm going to hold them. Because today he's offered, like the Zandu example, he's offered 6,500, but in the future, I believe he could offer 10,000, 16,000. So let me buy more and more shares, and I will sell it later at a higher price. And as the demand goes up for these shares, the price also automatically goes up.
Understood. So maybe you have on your screen the L&T case study. You've put a white knight defense there. I know you spoke about the white knight a little bit, but there's actually a question saying, can you explain uh, practically what would a company need to do to use a white knight defense? I mean, language being whatever it is.
Yeah, so let's quickly touch upon what a white knight defense is, right? A white knight defense is effectively when a company which is under threat of a hostile takeover reaches out to a friendly third party and requests them to buy a stake in the company, thereby dissuading the hostile party. And we have a very successful example in India when ITC was trying to launch a hostile takeover vis-a-vis EIH, which is the Oberoi group. You saw that EIH reached out to the Reliance group as a white knight, and Reliance bought those shares, and the entire ITC hostile bid was effectively mitigated. We have also seen the white knight defense work in various contexts and in other jurisdictions as well. So practically the way this works is really simple. You reach out to potential investors. It could be private equities, it could be family offices, it could be other high net worth individuals, and you tell them that, look, there is value in this stock. Let's in the L&T example, let's say Siddhartha's shares, right, the 20% which was bought by L&T. If the promoters were in a timely manner able to find an alternate buyer for that 20% at say at a similar or better price, then it's possible that that would have been bought by an entity which is not L&T. In which case, if they're not hostile, they're not looking to take over control. Interestingly, the takeover regulations also have an indirect sort of regime for a white knight defense. So the takeover regulations say that if somebody is to launch a hostile takeover or any takeover, and here let's use Tidewater as an example, right? So in that, Standard Greases launched a takeover, an open offer. Now, if there was another third party who wanted to come into the fray and challenge Standard Greases in its acquisition, you could have that party launch a competing offer, which would run in parallel with Standard Greases' open offer. They could have different prices, and the shareholders tender at the exact same time.
Understood. Okay, so I'm just conscious of time. I have 3 questions for you, and the balance to our crystal ball gazing. So I'm alerting you to that now. Let's start with the easy one first. In particular, in Tidewater, can you clarify the concept of untriggered open offer? If you can just talk through that.
Yeah, this is one of my favorite topics. So, okay, an open offer trigger is based on a couple of things. The first open offer trigger is if you buy 25% shares or voting rights in a listed company. If you already hold 25% shares, then every year there's a creeping acquisition limit of 5% in a financial year. If you breach that, then you trigger an open offer. The second is if you acquire control of a listed company, whether you buy any shares or not, right? If you have the right to appoint majority directors with 0 shares, you've triggered an open offer. The presumption in all of these cases is that there is an underlying transaction which either gets you to the 25% up or gets you the control. But the regulations are entirely silent on a setup or an approach where you have the intention to acquire control. So you don't need an underlying transaction, and this is something that we have tested with SEBI, and SEBI of course has allowed it in cases to say that, look, I as a public shareholder want to become a promoter. There is no underlying trigger here, so it's untriggered, but I'm making an open offer because I want to. This doesn't harm anyone because an open offer only results in better price discovery. It gives an opportunity to the public to sell their shares only if they want to. If they choose not to sell, they don't have to. And it gives a shareholder the opportunity to offer a higher price and take control of a company, as was successfully done in Tidewater.
Understood. Before I go to the crystal ball gazing, there's an interesting question here. Uh, what are the boards, and I will add company, what are the boards or the company's disclosure obligations in relation to a hostile takeover? And are they significantly different from a friendly takeover?
Well, to a certain degree. Now let's take friendly takeovers first, right? A friendly takeover entails either a primary infusion into the company or the promoters entering into a contract of a share
Correct.
purchase, or maybe a combination of the two.
Right.
In case the company is fully aware that there is a transaction which is happening. So the disclosure that comes out, and as we normally refer to as a Reg 30 disclosure, is to say that look, parties have entered into a contract, and therefore an disclosure is being made and an open offer is being made. In a hostile takeover, on the other hand, the company is not aware of what is happening. The best hostile takeover is where the entire bid is a surprise, because if the company is aware that a bid is coming, they will prepare, they will try to defend themselves beforehand, right? And we have been part of certain takeover defenses where we have, through market leaks, become aware of potential bids at a hostile takeover, and we managed to successfully defend those. So confidentiality is key. In a hostile takeover, the disclosure that comes is effectively in the form of the public announcement, because the day you launch a hostile takeover, you've gone to the stock exchanges, you've gone to everyone, SEBI, and you said that, look, I've launched a hostile takeover. This is my public announcement. Now this copy goes to the target as well. So the listed company in turn is obligated to also disclose this to the stock exchange, but in effect, it's already in the public domain.
Exactly. Exactly. Understood. Okay, so now coming to my crystal ball gazing questions. So the first one, and there are 3, 4 different questions on this. Some is on like 26.2, some is on something else. Essentially saying, are our laws capable of addressing hostile takeovers from a promoter perspective? And if you are an acquirer, do you need something more in order for there to be fair play in hostile takeovers? So really, what should change in the law, if anything?
Yeah. No, so it's to my mind, it's actually a blessing that we don't have a defined regime for hostile takeovers in India. It actually opens up the playing field on who has the better strategy, who has the better wallet, often an important consideration. Um, uh, from a promoter perspective, of course, there are many defenses available. I think one of the key being to be prepared. Like, I know for a lot of our clients, there is a regular sort of Ben-Post check, which is your Friday, shareholding that you get to see whether there is any capital buildup that is happening from unknown entities. Is there a potential takeover bid that might be expected? During an open offer, there are certain restrictions on the target company to operate in the ordinary course of business. If you're hiving off assets, you need a special resolution. There are certain inbuilt protections where the public shareholders could also play a role. But having said that, the regulations also equally allow somebody to go and launch a hostile takeover if they want to, without putting any fetters on them. Because again, going back to the very basic of a hostile takeover is a voluntary process where the success or failure of a hostile takeover depends on participation, and that participation has to happen from the public shareholders. So it's really about who makes the better case and better structure to get more public shareholders on their side.
Understood. So last question. We picked up case studies, started all the way back from Imami and Zandu, came a little bit closer to today's date. What's your sense on trends? Not a legal question, but more a question of saying, do you see more and more hostile takeovers coming, or will it reduce? And what's the take?
Yeah. See, I'm obviously a little biased because this is bread and butter for me. And I actually enjoy, so my world sort of revolves around this in a lot of ways. But if I'm just to speak of what we've seen evolve in the market, we do see more and more hostile takeovers occur. And this is a normal progression of any economy. If you look at the US or the UK, there you had a phase where hostile takeovers increased over time. In India as well, we are seeing more and more inquiries, more and more deal structures which involve a hostile takeover of some nature. There are some we are working on right now. We are working on defenses. We are working on potential acquisitions. So it is definitely something which we will see more and more happen. And something intrinsically connected to this also is a shift in the model of how Indian listed companies are held. If you remember, the starting position was that most Indian listed companies are majority held by promoter families. Now, over time, we see a lot of these companies, the promoter families actually diluting their stake because the next generation doesn't want to continue in the same business. So they slowly move from the manager to the owner model, and they slowly reduce their shareholding over time. Now, as this shareholding keeps coming down, you hit sub 50%, and as you keep going lower, you become more and more ripe for hostile takeovers.
Great. So I'll tell you what, our audience definitely has a sense of humor, because I have a question from somebody saying, why isn't there a Dark Knight defense? So I think on that note, we will come to an end of the Q&A. If I can request you, Abhishek, to switch to the poll slide. And Mitesh, if you can please bring the poll up for our lovely audience, who have a lovely sense of humor, as we can very clearly see. Okay, give it another minute. Great. The poll's up. So if we can request everybody to please give us this feedback. It is incredibly valuable for us and very encouraging, provide support for future initiatives. We'll also separately send you a feedback request form. It's short and crisp, doesn't take more than a minute. If you can give us feedback on how we should address maybe future topics, fine tune what we've done today, we'd love to hear from you. Great. Thanks to everyone who participated in the poll. And maybe if we can just conclude and summarize today's webinar. I enjoyed it. I thought we had far too many case studies, and I think Abhishek, you did a fantastic job of picking just the right ones to illustrate all your points. But if I have to look at it from a bystander's perspective, I think clarity on the end goal and what is the roadmap to achieve it. Like you said, it's like a jigsaw puzzle. It has to fall in place beautifully. Otherwise, there will be clumps and wrinkles, and eventually the picture will not look nice. And because speed and confidentiality are an absolute key when it comes to conducting and, more importantly, completing public M&A, it just emphasizes the requirement of having very experienced, very knowledgeable practitioners by your side. So I would like to thank you, Abhishek, for the presentation, and many thanks to our live and recorded audience. We hope you found the webinar interesting and a worthwhile investment of your time. Clearly, some people seem to have enjoyed it. And please don't hesitate to contact us should you need anything from us. Our contact details are on the slide in front of you. Thank you for your attendance in today's webinar, and we look forward to staying connected in future editions of the M&A Academy. Thank you very much, ladies and gentlemen.
Thank you, everyone.